a long entry, we want to place a buy stop order one tick above the high of the bar. And with range bars, this is something that we can do, because with a range bar, we know that if we end up exceeding our range, which in this case, if we trade up to 20.1175, one tick above the high of the bar, we'll have a new bar open, and that's when we want to get into a trade. With a buy stop order, a buy stop order becomes a market order once that price point is hit. So with a buy stop order, we could put this order in the market and it can sit there. If the market then comes back down and we close lower, we cancel our order. But if the market ends up moving higher, we get the new bar opening, then we are going to be long the market. And in this case, let's see what happens. On the next bar, we see that we open at 20.1175, the market pulls back a little bit and then ends up closing higher. So in this case, we would have entered the market and we would be filled approximately at 20.1175, and we would be in a simple strategy long trade. Now, once we're in a trade, many people will say that getting into the market's easy. It's getting out that will make or lose you money. And so getting out of the market is extremely important. And we have three things that determine whether or not we should get out of the market. So simple strategy exit rules would be, number one, a profit target. Number two, stop loss. Number three, change of direction. So we're looking for one of these three things to take place for us to get out of this trade. Now, the profit target is going to be based on a concept that is known as the average daily range. We'll abbreviate that and call it the ADR. The average daily range is the high of the day minus the low of the day divided by 7. What we're looking for is the high of the day minus the low of the day, not Rob Lowe, L-O-W-E. The high of the day minus the low of the day gives us the range. But what we want to do is average the range over 7 periods, 7 days. And this will give us a reference for the type of volatility that we're seeing in the market. If we have low volatility and there isn't a whole lot of movement, we're going to have smaller ranges and a smaller average daily range. If we have greater volatility and the markets are really moving, we're going to have high volatility and a higher average daily range. And we're going to use this to determine when to get out for a profit and also when to get out for a loss. So, based on the average daily range, we can determine our profit target. And we're actually going to take 15% of the average daily range and use that as our profit target. Our stop loss is going to be 10% of the average daily range. And by taking just a small part of the average daily range, we're using realistic profit targets in the market based on the reality of how the markets have been moving recently, and we're also using a stop loss that's a small percentage of the average daily range that's appropriate for current market conditions. Now, just like we mentioned that volatility will change and the average daily range will be higher or lower depending on what's going on in the markets, this means that if the markets are giving us a lot of volatility, we have a larger stop loss, so we can stay in the market and accommodate small fluctuations in price to try and go for a larger profit target. If we have low volatility in the market, we're just looking for smaller exits or smaller profit targets and smaller stop losses as well. So these are known as volatility based exits, and it's one of the reasons the simple strategy is so powerful. Now, the third thing that we want to see here is if we haven't hit our profit target, if we haven't been stopped out of the trade, and we see that the market is showing a possible change of direction, which is a black bar, and this is MACD not bullish or bearish. Remember, a black bar just means that the conditions for an uptrend or downtrend are not present. And if we're in a trade, if we're long the market, then we get a black bar. That will be the third reason to get out of a trade. So let's see what the average daily range is and determine our profit target and our stop loss. Now, the average daily range can be calculated by hand. Once you have the range of the last 7 days, it's pretty easy to update it daily and calculate it manually. There's nothing wrong doing it this way. If you do have charting software that allows you to create custom highlights, then you can actually program it to make it super easy to know exactly what it is. That's what we've done here. And based on the ranges of the last 7 days, the average daily range for the E-mini S&P is 28.25 points, and we can calculate then the target based on 15% of the average daily range, which in this case is 4.25 points, and a stop loss that's 10% of the average daily range, which rounded is actually 2.75 points for the stop loss. So based on an entry at 2011.75, we'll first put our stop loss in the market, and this would be at 2009 here. Our profit target being 4.25 points would be at 2016. So actually, no, that's correct. So we have a target, we have a stop loss, and the third reason to get out of the trade is because of a black bar, which is just simply telling us that MACD is no longer confirming the trend. Here with an entry at 2011.75, we see our profit target, we see our stop loss. The market's trading at 2015. And on this bar, we get as high as 2016.25, one tick above our exit. So in this case, had we been filled at 2011.75, then we would have been out of the trade here with a profit. In the E-mini S&P, 1 point is worth $50, so a quarter point is worth $12.50, and this would be a $212.50 profit target, and with a 2.75 point stop loss, that would be a $137.50 stop loss. But our profit target is hit, and we are out of the market for a profit in this example. Now, just to be clear here, with a profit target, with a simple strategy exit rules, if we are long the market, our profit target, if we are long, is a sell limit order, and our stop loss, if we are long, is a sell stop order. So these would be the actual orders that we're looking to put in the market. If we're long at 2011.75, then we'll use a sell limit order for a profit target. We'll use a sell stop order for a stop loss. And a lot of trading platforms will allow you to set brackets where you just enter the number of points here, where you convert it to ticks. And since 1 point is going to include 4 quarter points, this would be a 17 tick profit target in this example, and it would be a 9 tick an 11 tick stop loss in this example if we were setting our trading platform to use auto exits and to have that profit target and stop loss set for us once we enter the market. So this would be an example of a long trade. But let's continue to look for opportunities here and see if there are any other opportunities that come up. Keep in mind that we use exit orders and we use the average daily range for a reason. Based on our experience in testing, we know that this is a reasonable request from any strong trend in the market for the market to move 15% of the average daily range. What we don't want to do is just hold on to the trade and to give back profits unnecessarily. This is what too many traders do. But with the simple strategies, we know not only when to get into a trade, but we know when to get out of the trade for a profit or for a loss. And this will help us take profits before the market turns back around. And we see here, in this example, the market has done just that. After going through our target by 1 tick, we're now back to 1 tick below our entry point. So it was almost a picture-perfect exit with this example. Now you'll see that the market starts to move higher again. Things get a little choppy at this point. What I would like to see after there's a valid simple strategy entry, I would like to see a black bar before considering a new entry opportunity. We don't want to chase the market. We don't want to get into the market too late. Instead, we're looking for a strong trend, and we're looking to get into that trend early. That's what our simple strategy rules are meant to do. Now, this is where we see a black bar. So a black bar means that we no longer have an uptrend, we do not have a downtrend, and we can look for the next trading opportunity based on our rules. Now, price starts to tag the lower Bollinger Band, which is what we want to see for a downtrend, and this is when we might start to consider a possible simple strategy short trade. But let's consider our rules for a simple strategy short. For a simple strategy short trade, we want to see three things. So a simple strategy sell signal, we want three things. MACD below the signal line and below the zero line. Now, we see by looking at MACD that this is the case. We have MACD below the zero line and the signal line, and based on our programming we have a red bar, so that's easy to say that that is true. The second thing we want to see is that the lower Bollinger Band is angling down nicely. And here we see that the lower band is angling down. The next thing, though, is that price is tagging the lower Bollinger Band or closing near the lower Bollinger Band. Now, right now, it appears as though this bar is going to close higher, but we don't really know that this is going to be the case until the next bar actually opens. And so this is one thing that we could look at with range bars. We could have had an order down here, one tick below the low of the bar, because if the market came back down here and closed lower, then yes, indeed, price is tagging lower band and closing near the lower Bollinger Band, even though right now we're up here at 2010. So I would say that based on what we see, the information that we have right here, so far we have two scenarios for a possible sell signal. The third would be RSI less than 30 now, and remember that this is an optional filter. Now, looking at this chart, it's a little tricky to look at this one and to know whether or not it is a good signal. But while this bar was forming, it would have been one to consider, and we would have looked to put a sell stop order one tick below this low of the bar. Why? Well, we see that on the previous bar, RSI is below 30. RSI is giving us a value below 30. We also see that on our chart, based on the programming, we have a red triangle. This tells us that that indeed was the case on this lower bar, or on this previous bar. And even though the bar is up here at 2010 with range bars, we could put a sell stop order at 2007 and 3/4, because if the market comes back down here and closes lower, we're tagging the lower band, we have a sell signal, and RSI's reading of 37.98 right now would be lower and most likely below 30. So I'd say this is one that if we were trading live, we could have had an order sitting there waiting for that bar to close lower. But we see on the next bar, the bar actually closes higher, and so this is a great example, because if this ever happens, we simply cancel our stop order. Remember that to trade a long signal, we place a buy stop order one tick above the high of the bar. To trade a sell signal, we place a sell stop order one tick below the low of a bar. And if at the completion of the bar, the signal is no longer valid, we simply cancel that order. A sell stop order is only triggered if that price point is hit, and